Very good evening to our lecturer, Dr. Masnita. My name is Lim Wei Zhong, metric number 228413. I am representing Group 4 to present our technical paper entitled Managing Financial Assets for Improved Performance in Organization. Basically, our technical paper consists of 4 major parts, which are weighted average cost of capital, stock, bond, and derivative instruments. The first part that I will discuss is weighted average cost of capital. WACC is the overall return the firm must earn on its existing assets to maintain the value of its stock. It is also the required return on any investment by the firm that have essentially the same risk as existing operation. WACC is expressed as a percentage. The higher the percentage of WACC of a company means the return of specific investment should be higher to compensate for high risk. The function of WACC. The main function of WACC is an indicator that mostly used by company or investor to assess the value of an investment. The WACC is the minimum return that can only accepted by a company or investor. Let's say the value of a WACC is more than the company yield, it is said that the company's value is decreased. While if the value of a WACC is less than the company yield, it is said that the company value is increased. Besides, WACC also used by securities analysts in valuing an investment to determine a most profitable investment. Furthermore, WACC can be used as hurdle rate or benchmark to measure return on investor capital. The next part is stock. Stock is a share in the ownership of a company. From the view of economics, a share of a company held by an individual or group. Corporation raise capital by issuing stock and entitle the stock owners to partial ownership of the corporation. Stock are bought and sold on what is called an exchange. There are several types of stock, and the two most typical forms are preferred stock and common stock. Now I will discuss about how a company will select stock. Stock screens are one of the most common methods for introducing a means of selecting stock and building portfolio. A stock screen is a systemic process in which the universe of stock is sequentially reduced to a set of favorable securities based on the investor's preference. Stock screens typically are applied first based on the most important criterion, then the second most important, and so on until the entire set of the criterion identified by the investor. The example of criteria are market, industry, share price, market capitalization, PE ratio, dividend yield, EPS growth, and so on. The second technique in choosing stock is fundamental analysis. Fundamental analysis is a method of evaluating a securities that entails attempting to measure its intrinsic value by examining related economic, financial, and other qualitative and quantitative factors. Fundamental analysis attempts to study everything that can affect the securities value, including macroeconomic factors like the overall economy and industry condition, and company-specific factors such as financial condition and management. The end goal of performing fundamental analysis is to produce a value that an investor can compare with the security's current price, with the aim of figuring out what sorts of position to take with the securities. If the stock is underpriced, then the investor can choose to buy the stock in the market, while if the stock is overpriced, then they can choose to sell the stock in the market. The last technique in choosing stock is technical analysis. Technical analysis is the method of evaluating securities by analyzing statistics generated by market activities such as past price and volume. Technical analysts do not attempt to measure a security's intrinsic value, but instead they use charts and other tools to identify patterns that can suggest future activity. Technical analysts believe that the historical performance of stock and markets are indications of future performance. The example of indicators used in technical analysis are Bollinger Band, trading volume, moving average convergence divergence, and relative strength index. The next part is bond. A bond is a debt investment in which an investor loans money to an entity which borrows the funds for a defined period of time at a variable or fixed interest rate. Bonds are used by companies, municipalities, states, and sovereign governments to raise money and finance a variety of projects and activities. The rating agency and bond rating. Rating agencies or credit rating agencies evaluate the creditworthiness of organizations that issue debt in public markets. This includes the debt of corporations, non-profit organizations, and government, as well as securitized assets, which are assets that are bundled together and sold as a securities to investors. Rating agencies assign a weighted rate to each bond, which represents an opinion as to the likelihood that the organization will be able to repay both the principal and interest as they become due. The bond rating can be divided into two major groups, which are investment grade bond and non-investment grade bond. Investment grade bond consists of AAA bonds to BBB bonds, while the non-investment grade bond consists of BB bonds and below until the grade D. For the investment grade bond, debt rated AAA is the highest rating. Capacity to pay the interest and principal is extremely strong, while for the non-investment grade bond, the debt rated in these categories is regarded on balance as predominantly speculative with respect to capacity to pay interest and repay principal in accordance with the terms of the obligation. Bond default and bond default recovery rate. Bond default means that when the issuer of bond are unable to meet the legal obligation of debt repayment to the bondholder. In other words, they fail to promptly pay the interest and the principal when due or before due. The bond default recovery rate is referring to the value of the asset of the bond in where it can be recovery the debt when it defaults. Hence, it will be low the loss given default when the recovery rate is high. The bond migration and crossover strategy. The possible outcome of a bond migration are upgrade, downgrade, unchanged, and default. It will be affected in terms of the bond quality, risk, and price. For example, an investor buy a BBB rated bond. If the bond upgrade from BBB rated to AA rated, the credit quality and the rating of the bonds will increase. In the same time, the spread will decrease, which indicates less risk associated, and the price will increase, which the investor will get a capital gain from the price appreciation of the bond. The fixed income investors can adopt a crossover strategy or 5B strategy in order to benefit from the credit risk migration. This strategy means that the bond have split rating, which are investment grade for one rating agency and non-investment grade for another rating agency. When fixed income investors buy the bond that carries split rating, they predict that the bond will upgrade from BB to BBB. In this case, the investor can benefit from the credit risk migration in terms of yield and price. When the bond is upgraded, the yield will decrease and the price will increase. This will make those investors have less risk and obtain capital gain from price appreciation of bond. The last part of our technical paper is about the derivative instrument. Derivatives are securities whose value depends on the value of another more basic variable, such as the value of linked assets. For example, commodities, ordinary shares, bonds, currency, and others. Some derivatives are traded on exchange, where contracts are standardized and completion of the contract is guaranteed by the exchange. The main reason in using derivative instruments is to hedge against risk and fluctuation in the market. So I will talk about the options. Option contract confer the right depending whether the reporting institution is the purchaser of the writer, respectively, to buy or sell a financial instrument or commodity at a specific price called the striking or exercise price up to a specific future date. Options include two classifications, the call option and put option. Call option is an option which gives the right to buy the underlying asset at a strike price. Meanwhile, the put option is an option which gives the right to sell the underlying asset at strike price. So, for call option, if the spot price is more than the strike price, the holder will choose to exercise the option because they will gain the benefit. While if the spot price for call option is lower than the strike price, they will choose not to exercise the option. For put option, if the spot price is more than the strike price, they will choose not to exercise because they will lose in the market. While if the spot price is less than the strike price, they will choose to exercise because they will gain. The forward contract. A forward contract is an agreement under which a business agrees to buy a certain amount of securities on a specific future date. The purchase is made at a predetermined price or rate. By entering into this contract, the buyer can protect itself from subsequent fluctuations in the market. The intent of this contract is to hedge the securities position in order to avoid a loss or to speculate the future change in the market in order to generate a gains. That's all from our group. Thank you.